Dear friends, in this video we are going to discuss about the important terminology called working capital. In the entrepreneurship development, in the unit 4, we have financing and accounting. In the financing and accounting, important concept is working capital. Working capital is a very essential component for maintenance of day-to-day activities of a company or industry, and how it will affect overall growth of the industry, how we can manage, what are the methodologies available in working capital management. So in this video, short video, we are going to discuss about these important points. Before going to the working capital management, we should know what is asset and what is liability. We are familiar with the terminology asset and liability. Asset is nothing but the building, we can say it is an asset. Car, if you have the car, that can be termed as asset. Cash in hand, that is asset. Accounts receivable, whether we have to receive any account from outside, that is called asset. Prepaid expenses, that is already we are advance payment, that is also asset. Inventory, whatever the stock we have in our godown, that will be coming under the category of asset. Furnitures, machinery and equipment, buildings, land, all those things will be coming under asset. Another important intangible asset, that is copyright, trademark, patent. All those things will be coming under asset. I hope now you may have the better idea about asset. Asset is a plus. If you want, we can simply remember like plus. Whatever we have, that is called asset. Cash, building, car, equipment, machinery, furniture, land, patent, copyright, trademark, all those things will be coming under assets. Okay. Liability. Liability means whatever we have to borrow, we have to return back. That is accounts payable. Accounts receivable is asset, account payable, that is what we have borrowed, that we have to repay it. That is called liability. And accrued expenses, that is interest, wages, taxes, etc., will be termed as liabilities. Deferred of tax liabilities, credit cards payable. We are borrowing some equipment or some purchase based on the credit card. We have to repay that in 45 days or 50 days depending on the terms of the company. So that is called credit card payable, will be classified as liability. Unearned revenue, that is also a liability. Loans and lines of credit, whatever loans we have borrowed, that is called liability. Mortgages, that is if you are putting our land document and getting money, that is also called liability. Lease, that is also coming under liability. So these are the common assets and liabilities, which are important terms we have to understand what is asset and what is liability. Okay, now we will come to working capital explanation. That is how we will understand the working capital. That is cash, machinery, finished goods, account receivables, all will be coming under working capital. For example, they are saying that it is a difference between company current asset and current liability. Current asset is whatever we have, current liability means whatever we have to give out. Asset means available in hand, liability means we have to give it to others, that is minus. So if you look at this example, simple example, current asset, we are saying cash, inventory, raw materials, accounts receivable, all are called current asset. Liability, we have to pay to the laborers, we have to pay for the day-to-day activities, utilities, we have to pay the tax, we have to pay the debt due within a year, whatever we have borrowed, loan, mortgage, something we would have borrowed, for that we have to repay the loan. All those things will be coming under liability. So working capital is nothing but it is a difference between company's current asset and current liability. Why we are talking about working capital? It will help us to plan our future needs and ensure the company has sufficient cash or cash equivalent to meet out the short-term obligations. Short-term obligations such as unpaid taxes and short-term debt. So in the example, we are seeing that how they arrived the working capital, current asset, whatever they have in hand, and minus liability, whatever they have to pay. So the difference is called working capital. I hope now we have understood what is working capital. It's a difference between current asset and current liability. If it is liability is lesser, then it is better. So we have to see to that we should have proper balance. Otherwise, the day-to-day activities will be affected. If you are not having the sufficient fund, day-to-day activity will be affected. So that is called working capital management. From where we are getting the sources of working capital? Spontaneous, short-term sources, long-term sources. Spontaneous means trade creditors, sundry creditors, note payable, accrued expenses. Sundry creditors means those who borrowed loan from us and they have to return it to us. That is debtors, sundry debtors and sundry creditors are there. Tax provision, dividend provision. Short-term sources, external means bank overdraft. See, bank overdraft is nothing but because of our goodwill, the bank will give us a loan. That is called overdraft. If you have 5 lakhs in the account, but they will give us 10 lakhs. Bank overdraft, cash credit, public deposit, bills discounting, short-term loans, etc. All will be short-term sources. Long-term sources is retained profit and depreciation provision. External means share capital, long-term loans, debentures. In this diagram, this picture shows us the working capital management objectives: smooth operating cycle, lowest working capital, minimize rate of interest or cost of capital, optimal return on current asset investment. These are the objectives. The importance: ensures higher return on capital. Everyone is working for profit. Return on investment is very, very important for small scale industry or medium scale or higher scale or mini, whatever the thing may be. We will expect the return on investment. That is the basic thing. Improvement in credit, profit and solvency, increased profitability and liquidity, readiness for shocks and peak demand. Working capital deciding factors are liquidity and profitability. Limitations: it is not so flexible at the time of sudden changes. Knowledge of all the ratios and variables is required. So advantages of working capital management: it ensures a liquidity when required. Liquidity means cash, not as a check, not as a credit card, not as a debit card, not as the investment in bank or deposited in bank. The liquidity means we should have the cash in hand. It avoids interruptions in operations. That is, operations will be smoothly conducted. The day-to-day operation, day-to-day activity, production activity, service activity will be organized without any hurdle if you have sufficient working capital. So that it will maximize the profit and it will help us in financial health, and it will develop competitive advantage due to streamlined operations. Disadvantages of working capital: it only considers monetary factors. Yes, it ignores non-monetary factors like customer and employee satisfaction, government policy, market trend. Yes, yeah, this is true. This is also true. Since we are very much worrying about cash on day-to-day activities, we are not giving much importance for customer or employee satisfaction or government policy, etc. And difficult to accommodate sudden economic changes. Yes, if there is any sudden announcement by the government or SEBI, it will become difficult to adhere. So these are some disadvantages in working capital. So this simple diagram, as we have seen in the previous case, the same thing. Thank you for watching this short video. Thank you.